from our theme song, the overture, Mr. Tell, and it was the same overture used for the Superman shows, for those that remember those, back in the 60s. But nonetheless, this is the This Week in Economics on the 11th of August, 2018, from WBRN Radio and the Bostonred Network, beaming from the Numbers Man channel. This is an interesting week here. We'll start with the Consumer Price Index released by the Bureau of Labor Statistics. Let me get to this. Okay. Anyway, nonetheless, it was released on the 10th of August, and we will put this in the show notes, so never fear. What we attempt to do here is dive a little bit deeper than what you get with your ordinary newspaper. We used to say newspaper. Web readings, we'll say, and some of the analysis there, we'll be able to do that. We also have some PCIs from the people at Market. And they have PCIs on various things. We'll look at the U.S. and we'll look also at China. And we'll do the gas report this time from the AAA people. We'll be using the gas buddies, but we'll vary around. We'll talk a little here from Bloomberg about data that is used by the Federal Reserve and others. The punchline, I suppose, is that we have a better data now, big data, than ever. And the Federal Reserve, the people at the Bureau of Labor Statistics, etc., are using many, many different things. As we do here at Cranston Analytics, we have our seesaw models. We scrape, as they say, data from many, many sources and adding more sources every day. And this is where it's going. In fact, they're getting into things like credit card swipes as they looked at Hurricane Maria and how it affected South Florida. We'll get into that in a minute here, but let's get to the Consumer Price Index. For urban consumers, it increased at 0.2% in July on a seasonally adjusted basis after rising 0.1% in June. You're going to see more of this. Over the 12-month period, 2.9% seasonally adjusted was the Consumer Price Index. The index for shelter at 0.3% in July accounted for 60% of the seasonally adjusted monthly increases in all items. The food index slightly in July, rose slightly in July with major food groups mixed, and we'll get into that in a minute. Energy at 0.5%, and all of the major components declined. Index for items less than food rose at 0.2% in July, the same as in May and June, along with a shelter index for used cars, trucks, airline fares, new vehicles, household furnishings, in operation and recreation all increased. The index for medical care and apparel decreased. Index for all items rose at 2.9% in 12 months ending in July. The index for all items less food energy rose at 2.4% for 12 months ending in July. This was the largest 12-month increase since the period ending in 2008. The gateway to the Depression, the most recent one. The food index increased at 1.4 attempts over 12 months, and energy at 12.1%. As you can see where this is going here. Some nice graphics. We'll move along here in January, looking at energy here, 3.0. And we go to July. Let me look at energy commodities. I actually went down negative 6 there. We are just looking at some of these along here. July used vehicles a negative 3. Here, let me just. Okay. New vehicles for July at 1, and used at all vehicles at 3, used and vehicle, cars and trucks at 1.3. Medical apparel, clothing, that was a -3. Okay, now we kind of medical care commodities, a -1.1. Shelter at 3% increase there. Transportation services at a -5. Healthcare services at just 1. Well, some of the things, and these are all seasonally adjusted. The food index rose 1/10% in July after increasing 2% in June. Probably some of that is related to fresh vegetables grown within the home area. Just a guess. The index for food away from home rose at 1/10%, while the index for food at home rose 0.2% in July, the same increase in the prior month. And we are getting to that. 3 of the 6 major food store groups index increased, with the index for food and vegetables rising at 1%, and the index for fresh vegetables rose at 1.9%. The index for meat, poultry, fish, and eggs increased 0.3%. Index for other foods at home advanced 1/10%. In contrast, the index for dairy and related products actually fell 0.6% in July, rising 0.7% in June. The index for cereal, bakery products also declined, falling 0.2%. After rising in June. The index for non-alcoholic beverages was unchanged. The food at home index increased 0.4% over the past year. 4 of the 6 major grocery store food group indexes rose over the span. The index for meat, poultry, eggs, and fruit and vegetables 0.9% over 12 months. The largest increase amongst the group. The index for dairy and related products, non-alcoholic beverages, both declined over the past year. The index for food away from home increased at 2.8% over 12 months. Energy fell 0.5% in June after declining 0.3% in July. In June, the index for gasoline, natural gas, electricity all declined modestly in July. The gasoline index fell 0.6% in July after rising 0.5% in June. Before seasonally adjusted gas prices declined 1.4% in July. Electricity fell 0.4%. The index for natural gas fell 0.5%. It's consecutive decline. The energy index increased 12.1%. Year over year, gasoline increased 25.4%. Now you see where things are going here. Electricity index fell 0.8%, and natural gas declined 1.3%. Shelter rose 0.3% in July, followed by a 1.10% increase in June. The index for renters and owners equivalent rent both rose 0.3%, the same as in June. The index for lodging away from home increased 0.4% after falling in June. Excuse me. The index for used cars and trucks at 1.3% in June. The index for airline fares at 2.7% after falling each of the prior months. The summer travel season. The new car index rose 0.3%. Its third consecutive increase. The increase for household furnishings and operations in July advanced 0.3%. Recreation at 0.2%. Medical care index declined in July, falling 0.3%. The index for prescription drugs fell 1% in July after rising the last 3 months. Physician services fell 0.2%. In contrast, hospital services rose at 0.5% in July. The apparel index declined in July, falling 0.3%, and the index for personal care was unchanged. And let's see here. The consumer price for all urban consumers increased 2.9% over the last 12 months. And the consumer price index for urban wage earners and clerical workers increased 3.2% over 12 months to an index level of 2.24. Let me try it again. At 246.11. The chained consumer price index for urban consumers jumped 2.7% over 12 months. The index was unchanged on a not seasonally adjusted basis. The schedule for consumer price index for August will be released on Thursday, the 13th of September, so stay tuned for that particular one. And we won't go into the explanation of CPI. We'll just kind of skip it, as they say. We pretty much covered most of this, so we won't mess around with it. Let me just highlight a few little items here. Let's make sure that I have the June, July. Okay, first column. These are seasonally adjusted from June and July. Tobacco smoking products, 1.10% was increased there. Shelter, rent of a principal residency, 0.3% increase there. Owner's equivalent of rent of residences, that's the same thing, 0.3. I think we went over that once. We won't go through food at home. Cupcakes, crackers, bread, and cracker products increased 0.6 there. Meat, beef, and veal, 0.5% increase there. For the pork lovers of the world, bacon, breakfast sausage, related products, 1.1%. Bacon and related products, 1.6%. Ham, it fell a negative 1.6. It's kind of interesting here. Pork chops, including roast steaks and ribs, down a negative 0.1%. The chickens of the world at 0.7%. Fresh whole chickens at 9%. 0.9%, excuse me. Frozen types at 0.5%. Fish, fresh fish, a negative 0.7%. Very interesting here. Anyway, some of the things there. Let me. June to July. This is 2018. If we look at the eggs, they were down 0.6%. Fresh vegetables, we only run over this, is 1% increase in fresh vegetables. They even break this down like apples. Apples at 1.7%. Citrus food at 2%, and bananas at 0.8%. Lettuce evidently accelerated at 6.3% there. Tomatoes at 0.5%. I knew about potatoes, but anyway, at 0.4%. So you can see some of these basic kinds of staples all went up. Period. Carbonated drinks, they were down 1.1%. I guess people are moving away from those. Coffee down 0.2%. Roasted coffee down also 0.2%. I don't know about instant coffee. Anyway, that's 1.1%. I guess some of us still drink instant coffee occasionally. Butter was up 0.3%. Why am I going through this? Well, some of this stuff you run into that people use. Spices were down 0.4%. And food away from home up 0.1%. Full service food snacks 0.2%. This is from June to July. Food at the school sites, interesting, 1.8% there. And haven't seen that statistic before, so that's probably why we're doing this. We won't get into energy services here. Major appliances, they were up 3.5%. This is one of the things we'll look at, because those major appliances, some of the materials used in them will land under the Trump administration's tariffs. Laundry equipment, 0.3% so far. Bedroom furniture, it was down 1.1%. And we won't get into the clocks. It's really extensive here. I invite you to look at some of this stuff. Tools and supplies, 0.4%. It was up. The apparel business, I'm surprised. Men and boys apparel, make sure up 1.7%. Pants and shorts, down 2.4%. Footwear, 1.1%. Kind of looking at some of these things here. A little bit of more curiosity. We'll wind this down. Education and communications commodities, a negative 0.9. College textbooks, one thing we're involved in. At 0.5%, information technology commodities, a negative 1.2%, personal computers, etc. All of those are down, and peripherals are negative 2%. Computer software at 1.2%. Telephones, hardware, calculators. I don't know if anybody's using those anymore, but anyway, at 1%. Alcohol beverages at home, a negative 0.3%. I'm not sure. Distilled spirits at home, 0.4%. So it didn't go down as much. There we are. Cigarettes, 0.1%. They went up. Other products at 0.2% there. So they actually really break this down to minute. Eyeglass, eye care at 0.2% is how it increased. I think a nursing home and adult care services at 0.2%. Health insurance, negative 0.2%. I think we got on that one before. Anyway, this is from the Pew people. For most U.S. workers, real wages have barely budged in a decade. That is 10 years. U.S. unemployment is at record lows. We all know that, at 3.9% in July. And the nation's private sector employment has been adding jobs for 101 straight months. 19.5 million since the Great, they call it Great Recession. We call it Depression. Abating in 2010. That would be 8 years ago. And 1.5 million jobs have been added since the beginning of 2018. Americans' paychecks are bigger than 40 years ago, but the purchasing power is barely budged. The disconnect between the job market and workers' paycheck is fueled much of the recent activism in states and around us, raising the minimum. The average hour earnings for management private sector workers, it was $22.65, up 3% from June, and 2.7% above the average for a year. That's from the Bureau of Labor Statistics. Vast in line with the average wage growth over the past 5 years, year over year, has ranged from 2 to 3% since the beginning of 2013. But the year just below 2007 was a negative 0.8%. there in the Depression. After adjustment for inflation, and this is where we'll leave this, today's average hourly wage is just about the same purchasing power it did in 1978, following a long slide in the 80s and early 90s. Inconsistent growth since then. In fact, in real terms, the hourly earning peak of more than 45 years ago, that was $4.03 an hour. Record that was in 1973 has the same purchasing power, oh boy, as $23.68 today. Remember those days. Similarly, employment of full-time and salaried workers tell much the same story by over a shorter period of time. Medium usual weekly earnings range from $232 in the first quarter of 1979 to $879 in the second quarter of this year. But in real inflation-adjusted terms, the medium has barely budged over that period of time. That $232.79 has the same purchasing power as $840. We'll append this, won't spend any more time on it. The gas prices, well, $2.86, basically where they are. That's for the entry level, regular they call it. Premium at $2.41. Diesel the same at $3.15. Okay. Let's go into some of the PCIs here. Let's see, this is a U.S. service sector PCI. Healthcare activity accelerated to 18-month high is the takeaway here. Healthcare expansion quickened fastest since 2017. Technology leads output growth. Financial activity accelerates to 8-month high. The June survey signaled that the fastest increase in healthcare business activities is since January of 2017. This is from ISH Market here. For the first time since January, technology was the fastest growing segment. The rate of expansion were unchanged June 6 months ago. Meanwhile, financials and basic materials sector both recorded a sharp and strong rise in business activity in July. The upturn in the former accelerated to an 8-month high. Conversely, the output growth softened consumer service firms, with the rate increase easing to the weakest in 2018. Business activity growth also softened in consumer goods and industry segment there. So that's some of the things that happened, and let me see if we... Well, that is the end of that. We did not get the usual commentary here. An 18-month high. So that's where we are. Technologies, financials, industrial, basic materials, consumer goods, etc. And that is where we are. And no comment further than that. On we go to China's general services PMI. China's business activity expanded at a lower rate in July. The summary here is Service Composite Index. This is from the Shenzhen Composite Index, covers both manufacturing and services. They were at 53 point in June to 52.3, down slightly. Let me just... all right. Slowdown in overall growth momentum was broad-based, with both manufacturing service providers in China registering weaker increase in activity. The latest survey period, notably service sector output, rose at a slower rate for 4 months. July, as illustrated by seasonally adjusted Shenzhen General Services Business Activity Index, fell from 53.9 to 52.8. It's about a 10% drop. Growth in new orders also softened across monitored sectors in July, the most notably across the service sector. Moreover, the latest increase in new business placed with service providers, I almost said survivors, weaker records for 2.5 years, and modest, according to panelists. Relatively subdued market conditions have combined to a slower rise of new orders. At the same time, new business received by manufacturers arose at a softer pace since April. Consequently, new work at the composite level increased slower there also. Chinese service companies continue to add two of their payroll numbers during July. However, in line with trend for business activity, the rate of job creation softened since June, and only slight employment across China's manufacturing sector remains in a downward trend at the start of the second half of 2018. The rate of jobs shed eased slightly in June, and the composite level workforce rate numbers fell for the second month in a row, albeit marginally. Higher staff levels, increased efforts to clear unfinished workloads led to further declines in outstanding business. Though slightly, the rate of backlog depletion was the quickest recorded since 2016. In contrast, capacity pressures persist at goods producers at high, but by a further rise in level of work-in-hand manufacturing. Overall, outstanding business rose at the weakest pace since 2017. Higher staffing levels, increased efforts to clear unfinished workloads led to further decline in outstanding business activity. Average input costs continue to rise across both manufacturing and service sector in July, the former noting the sharpest rate of growth. The increase in input costs faced by goods producers remains steep. Despite the rate of inflation easing in June, meanwhile, service companies registered a strong rise in operating expenses. This was the case for input goods. Output changes rose both on monitored sectors at the start of Q3. The July survey signals a market deterioration in optimization amongst the service companies. So these were the key points here. Activity rises at its weakest rate across both manufacturers and service providers. Service sector new orders expanded at the weakest rate for 2.5 years. Overall business confidence fell to its lowest level since 2015. That is a China case. The PMIs are very good at picking up things. And that is it. All right, away we go. This is from Reuters. Energy executives lament Trump's tariffs as a cost rises on pipeline projects. Hadn't seen this before. Double tariffs on steel and aluminum from Turkey could push up costs even further for domestic and gas pipeline projects. Maybe that will defeat the XL pipeline. We couldn't defeat it. There are more than a dozen U.S. energy pipelines on the drawing board, some of which are still seeking financing. They won't get it. The projects will pave the way for greater U.S. Oil and gas exports and relieve a bottleneck in West Texas shale fields that is starting to pinch output in the region. Turkey delivers just 4% of steel mill imports, valued at $1.18 billion last year, according to the Department of Commerce. But doubling the tariffs on a supplier could force buyers to turn to other steel makers, no doubt about that. The administration's original move in March to raise tariffs on most steel and aluminum was proposed to safeguard U.S. jobs. That's already added $40 million to the cost of plain all-American crude oil pipelines. That's kind of interesting here, and that will use supplied by a Greek company. We are moving forward with the project, but believe that the imposing a tax on pre-existing orders is unjust, especially considering the specific materials we purchased ahead were not readily available in the U.S. So this is something we'll keep an eye on. Kinder Morgan, we've heard of them, the second largest U.S. pipeline operator, has already ordered nearly half the specialized pipe needed for the Gulf Coast expansion from Turkey. Steelmaker Bostonred Network before the original tariffs went into effect. That's from Sarah Hughes. The Houston-based company on Friday declined to comment on the impact of the project of doubling the tariffs. The $1.7 billion Gulf Coast Express is a natural gas pipeline in West Texas. Kinder Morgan has applied to the U.S. Commerce Department for exemption. All of them have done that, but basically speaking, the exemptions have been denied. The Turks can export to many other countries, but with a weaker lira, that is, their products become cheaper to buy. The cheaper lira, I suppose, actually can help increase their export volume. That's from George Giro. He is at RBC Wealth Management. Steel futures were up 1% at 907 per ton at the New York Mercantile Exchange. They are up 46% from $621 per ton a year ago. So it's costing more to deal with these people. Let's get UK growth here, boosted by warmer weather. The UK growth picked up 3 months to June as construction and services were lifted by better climatic conditions. That's for the National Office of Statistics. The economy grew by 0.4 in the period compared with 0.2 in the first quarter of the year. The Office of Statistics also said that the economy grew at 0.1 in June, down more than the robust 0.3 the previous month. So as the UK continues to fall back from its highest point at the end of last year, this is the manufacturing. In softening of growth, the Chancellor there, Hammond, we are pleased to see the recovery of the economy in Q2. Robust figures will point to underlying fundamental strength of the British economy. However, the office abstaining from their quarterly movement, the underlying trend in real GDP is one of slow growth. The UK economy grew at 0.6% in Q1, as of this year, compared with the second half of 2017, continually decline trend since the second half of 2014. So, head of economics, this is Siren Fran. No, wait a minute. Anyway, at the British Chamber of Commerce, while there was a welcome pickup in GDP growth in Q2, the figures have been flat somewhat by very weak first quarter, and so does little to alter the lackluster UK economy. We'll have this information here from the Bureau of National Statistics. They do a very good job, we hope they do, of anyway, on we go. Japanese economy rebound in Q2. Japanese economy shrunk in the first quarter of 2018. For the first time in 2 years, the economy expanded by a faster than expected pace of 1.9%, supported by private consumption. momentum is slowing the rate of growth in April to June. Expectation of 1.4% came after the world's third largest economy contrasted to a revised 0.9% in Q1. Consumer spending underpins the economy between June and July, while real GDP in Q2 was both strong and higher than the consumer forecast. We believe it's reasonable to conclude that the growth momentum for the Japanese economy as a whole is gradually starting to slow. So this is a little bit from the worldwide economy here. Figures came Japan's Minister of Economic Revitalization met with the trade representative in Washington. As a result, Japan has been focusing on other nations. Japan and the European Union signed one of the biggest world free trade deals, covering a third of the world's gross domestic product. So some movement here we see. We'll do this big data story here. This is from Bloomberg. Fed's mine data, big data for real-time clues on spending and payroll. The Federal Reserve deployed an experimental new tool as they scrambled to assess the harm done by storms hammering the U.S. last year. A troll of big data giving real-time answers there. Instead of guesswork and monthly retail readings, they use the card swipe information for its data corp, global payment technology company, to get a picture within 3 days of what Hurricane Harvey and Irma had done in the economies of Houston and Miami. Spending at stores and restaurants in Florida, Miami, and Tampa dried up almost completely, while in Houston decline was 75% from the normal spending level. 2 weeks later, the data showed that there had been no big above normal rebound. The information helped the feds gauge how much weather disruption there, and that's the Open Market Committee. A message reflected in the Open Market Committee's public statement on September the 20th. U.S. central bankers are gradually raising borrowing costs, no doubt about that. Skewed samples, unlike the government statistics, private data service sets aren't gathered with the question in mind, such as how much does the U.S. export last year. The samples can be skewed, and many times they are skewed there, and privacy issues abound, and data sets must be anonymous. We call it scraping. One reason government agencies are paying more attention, however, is that tools to analyze information are improving. That's from Brian Moyer. He's director of the Bureau of Economic Analysis. What has changed is not so much the ability of the data, but the data science tools used in our ability to process and use them in real time. Many real-time models, here at Cranston Analytics, we've been running a real-time model before even the Depression, anyway, the last Depression, 2008. Moyer said in the interview, adding that the Bureau of Economic Analysis is trying to enhance the accuracy of government reports, not replace them with private data sets, no doubt. It's a critical endeavor. The advanced estimate, this is from the Bureau of Economic Analysis, on GDP is released before the completion of the census quarter survey, so they have to input service sector consumption. What big data can do is mimic what the trends will be. Federal officials have worked along with 3 lines of inquiry: retail spending, employment, and price. The first 2 have been most fruitful. The goal there, better read to sense how useful this endeavor could be considered. The Bureau of Labor Statistics revised March 2009. Total non-farm employment was 900 and 2,000 below the estimate. Having the information sooner is a year when unemployment hit 10%. And this is ADP here. Fed is currently working with the ADP, that's automated data processing, which represents 1/5 of U.S. private sector, released a few days before the closely scrutinized monthly employment report. But for years, found analysis we tended to use to build a reliable proxy for the employment report. ADP's employment numbers represent a different slice of the labor market than the government's. For July, the ADP National Employment Report, a gain of 219,000 jobs and 157 from the Bureau of Labor Statistics. Both reports are different representations of the same reality. That's from Dr. Zanti, chief economist at Moody's Analytics, Inc., in Westchester, Pennsylvania, which consults with the ADP on projects. The BLS estimate is based on payroll records of millions of workers, and so too is the ADP estimate, just a different set of workers. And that's one thing to remember. It's a smaller estimate out there that use their services. Officials aren't trying to gain monthly payroll reports. They're looking at both the data and using statistical models to capture the message from both reports about a true employment. We are not accumulating the biggest data depository in the world for its own sake. That's David Wilcox. He's director of the Division of Research and Statistics at the Federal Board of Governors. I said our objective is to advance our ability to advise on monetary policies. Very clearly what they are doing here. Bloomberg, and we already went over the China data, size of stimulus, world economy weakened, no doubt. Economies are weakening. The trade war, both of these controls have been released. Money market lending rates have fallen sharply, with 7-day repo averaging at 2.4% so far in August. That's down 2.9%. This is in China, incidentally. A swap of Chinese data will provide a week ahead. Anyway, we don't have it yet. And these are some other markets here. The U.S. will provide some key inputs into economic activity for the quarter. Following forecast to redefine gross domestic product. It stood at now at 4.3%. That will not stand. The Bank of England's interest rate, 3 consecutive days of data from inflation to wages and retail sales, will allow policymakers to look at it. Bloomberg predicted the jobless rate edged a little lower to 4.1%. That's in the UK in June and July. Inflation at 2.4%. Germany's first attempt at measuring its expansion in Q2 provides somewhat of a glimpse. This is in the Eurozone. Germany's economy grew at just 0.5% after 0.3% the last previous months. In India, inflation is brought back to rates higher. Probably the CPI index is likely to mark the beginning of an extended slowdown. This is very important to look at these various economies throughout the world. We estimate the consumer price index rose 4.5% over year in July, down from 5% in June. Argentina, the International Monetary Fund is going there. The Norges Bank, they'll have an increase in September. The UK economy, this is Bloomberg here. The UK economy bounced back from the start of the year in Q2. Gross domestic product of 0.4%. Medium forecast in line with Bloomberg. We already covered it, so we don't really have to, whether it was a boost to it. Anyway, market data. This is from Europe, the UK. The FTSE was down 0.97%. It puts FTSE 100. The CAC that's in France was down 1.59%. The DAC in Germany was down 1.99%. The Euro story 60 was down 1.94%. In Spain, they were also down 1.6%. And we'll look at the Cinex. It was close anyway. It was down 4.1%. The Hang Seng was down 0.48%, and the Nikkei was also down 1.33%. And back to the Dow, it was down 0.77%. That would have been on Friday. The Nasdaq was down 0.67%. And the S&P 500 was down 7.1%. This is what we get here. And I look at commodities. Brent crude futures at $72.81. West Texas crude at $67.63. That is a plus 1.23%, and for Brent crude 1.03% there. T-Boone Pickens is jumping for joy. Anyway, on the Forex, down 0.2% at $1,211.65. And natural gas down 0.3%. So let me just backtrack here a little bit and go to the Bloomberg commodities. We'll just get their index in here. Oops. We were looking for commodities. We got currency. Oh, try it again. Anyway, the Bloomberg Commodity Index was down 0.77%. The UBS Bloomberg Index was down 5.78%. The Reuters Jeffers was also down 0.74%. The Reuters International was down 11.72%. The energy, this is Brent crude. Wait a minute here. This is Texas, no wonder. At $72.81. West Texas Intermediate was at $67.63. Anyway, looking at something. We already done natural gas. We'll do home heating oil. It was up $2.70. We did gold already. It was down 90 cents. And depending on where we do it here, this is on the Comdex, $1,219. And on the spot, it was also down $1.90 at $1,210.97. Silver was down 17 cents at $15.30. Pretty much has remained there. And we look at some agricultural stuff here. Corn is down $11. Wheat was down 17. And who else we got going here? Cocoa was down 11, negative 11, and live cattle, we still don't get pork bellies around here. It was up basically 29 cents. So that does it for the commodities. Pretty much have ended up the broadcast here. We went all the way around. PCIs, Consumer Price Index. We got them all in here on this report. This has been This Week in Economics on the 11th of August, 2018 from WBRN Radio and on the Bostonred Network. This is the Numbers Man, a part of it, our macroeconomics program that we're sponsored by Cranston Analytics. For those in business, make next week a productive one. And for the consumer, keep your eye on the prize. It appears the summer driving season is not as barbaric as it could be. As we enter, the second week in August, and the tariffs are starting to take effect. I think last week we talked about how long it normally would take for such things as the Trump's administration tariffs to integrate into the economy. Normally at least 6 months to a year, but things are much, much faster today, as from the company in Texas that expected this to happen, and they pre-ordered product, and now the tariffs are affecting that also, which means the cost of the pipelines will increase, and that will be just across. This is just with the Turkish steel, but the Turkish dollar has deteriorated. They will not have any problem selling their product worldwide because it actually costs less. So it is a mixed bag here. Where will the employment numbers be in the next 2 months or so prior to the all-important November elections? We invite you to check us out on the network as a Bostonred. For that update, we'll be covering the Minnesota election. That's next up, providing our voice stays up. And this will do it for us. Have a good weekend, everyone. We'll talk to you next week.